Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us remotely is Bob Smith. He's the President and Chief Investment Officer with Sage Advisory. We're going to take a look at how ESG portfolios are performing amidst COVID-19. Bob, it's great to have you with us. Thanks for spending the time in which is certainly unprecedented markets. Tell us a bit about Sage Advisory and how you're processing what's happening with COVID-19.
Sure. Good morning, Jill, and I am so pleased to be with you this morning on Earth Day. The 50th anniversary of this most important day is a cornerstone for the whole ESG and sustainable investment movement. And I was just a guy going into high school way back when it all started, but 1 billion people in 190 countries are going to celebrate the environment today. So, even with all this closure and so forth, we need to keep the focus on, improving our environment. And, I guess the whole COVID effort is all about that, isn't it?
It certainly is.
As far as, sustainable investing is concerned, and we here at Sage, we've been doing this for, at least 9 years now. And we do stocks and bonds, ETFs and so forth. But I think that the one thing I would say about sustainable and ESG kind of funds is they've been around. Many of them haven't been around beyond the last 5 years. And they haven't really experienced the stress test that we've seen over the course of the last several months, meaning a super bear market. And I got to tell you, their mettle has been really tested here, and they've really proven to be pretty good performers. And if you were just to look on the equity side to begin with, when you sit there and look at the S&P 500 last year, one of the best years on record, about 31.5% rate of return. But guess what? In the best year for the S&P 500, the ESG version of the S&P 500 had an even better year and returned roughly about 33.4%. So about 2% greater than just the broad conventional index. And you roll that forward for all the horrible situations that we found ourselves in from an economic perspective due to COVID and so forth. How have these funds really performed year to date? And I got to tell you, they have stood the test. So far, the S&P is probably down. This is through the 17th. Year to date, down about 10.5%. But guess what? ESG funds are only down about 9%. Now, that doesn't sound real big in itself, but that's about a 13% outperformance year to date. And it's only getting better. Why? Because of the energy component. So I think as we go forward, I think ESG not only has done well in the good years, but is really doing well when you need it to stand up for you. And I think this outperformance is really going to accelerate as we go forward, as I said, because of energy. But when you think about it, in the first quarter, 7 out of 10, 70% of sustainable funds finished in the top half of their categories across the board. I don't care whether it's large cap, mid cap, growth, value, whatever the orientation was, the majority of the ESG funds actually did quite well according to the Morningstar Universe kind of comparisons. And again, I don't care whether you're talking active or passive. Most of the ESG index funds, 24 out of 26 of them that are out there, beat their active conventional alternatives. So is this a time on Earth Day? I'm so pleased to be able to say ESG is standing tall and doing well for investors on the equity side. Just to finish it out on the bond side, because I know it's the flip side of the coin, the same is true there. What we saw last year was a stellar year for fixed income. Interest rates came all the way down. Corporate bonds were all the rage. And what did we see last year? The Bloomberg corporate bond index returned roughly about 14.5%. But guess what? The ESG version of that very same index, optimized for environmental and social and governance issues, generated about 14.5%. So you didn't give up any return at all for being sustainably oriented. And now what's happened this year? Oh my goodness. What we see going on year to date is actually quite admirable. So far, that same corporate bond index that Bloomberg puts out is up about 1.23%. That's not a lot, but it's not a negative. But more importantly, we find that the ESG version of that index is up 1.73%, 50 basis points. And in fixed income today, that's a lifetime, especially when you got a 10-year treasury that's only yielding 62 basis points. So that's about a 40% better outperformance. So stocks or bonds, ESG is not only all the rage, in the sense that it's a trend, but there is a good, solid performance reason in both good and bad markets as to why these are attracting more and more money.
And if we take a look at our next slide here, these are the drivers of ESG outperformance in 2020 that you had outlined before. And it's interesting what you said about moving away from these oil and gas related sectors, and that's going to help in markets where the economy is stretched because there's less demand for that kind of product anyway.
Yes, ma'am. I'll tell you that, what is the why behind this whole trend? And, companies with higher ESG scores tend to be more profitable. And that's through kind of an economic value lens. They tend to have more resources to invest in areas of ES and G kind of concerns, so that will really kind of buttress and strengthen their abilities in terms of sustainability. But we also find that their earnings are far less volatile. And so when you get into environments like this, high quality companies with superior ESG scores and very low controversies are generally very attractive. We know that because of their high profitability, steady earnings, and healthy balance sheets, that in environments like we're in, and certainly year to date, the adversities that the market is facing, this is the place you want to hunker down. And ESG really brings that to the fore. We also saw that on the corporate bond side, that typically if you have a higher ESG score, you'll have a higher credit rating as well. So there's a very strong correlation between quality and high ESG scoreness. Larger companies tend to do better in this environment. They also tend to have better and higher ESG scores. It's not to say smaller companies don't, but this is what we find in the data. And I think that when we sit here and look at factors, and I think that people like to think about the fact that energy and fossil fuels are generally the area of concern with regard to ESG. That is not the only concern. We want strong, vibrant companies that are doing well from a social and a government's perspective, not just environmentally speaking, but truly. You have to sit there and say, look, the fact that I was not overweighted in energy, which you'll find most ESG scores or funds are not, in fact, they're very underweighted, tended to do very well year to date, and given that the energy sector has underperformed. The other thing, too, is that they tend to be overweighted in consumer staples. And in environments like we find today, large brands, consumable brands, people tending to want to, stock up at home to be safe. All of these companies have done extremely well. Tech has had a little bit of a contribution. And I think information technology are the other areas where you typically will find ESG overweighted. And guess what? In the Zoom world, in the Netflix world, in the Amazon delivery world, that's all about ESG. That's the kind of environment we find in. So typically ESG funds will do quite well as a result of that.
All right, and to wrap up here, let's take a look at model portfolios because we're starting to see advisors incorporate this more into their strategies.
Sure. What we offered here, just a couple ideas in terms of model portfolios. And for the small investor, they often think, well, I can't pick all these stocks. I think in the world of ETFs, there's a lot of convenience, and there are some very good things that are being offered out in terms of exchange traded funds that are ESG optimized. And even today, we saw Morningstar has purchased Sustainalytics. Sustainalytics is one of the leading providers of ESG data. And for Morningstar, the largest purveyor of information on mutual funds and ETFs, to go out and bring that into their fold 100% tells you something about the future of ESG, particularly when it comes to ETFs and commingled funds, mutual funds. But in terms of global equity, you'll see here in terms of our distribution that we are definitely overweight large companies, a slight bias towards growth, which is where you'll find a lot of very positive ESG scores. We honestly aren't very much involved in terms of the small to mid cap world, and we tend to be overweight staples and very much underweight energy. And we think that the international emerging markets, while a nice place to be, is probably where you want to be more underweight than overweight. So we're favoring US, and we're favoring the sectors that we spoke about in terms of a little bit of more large cap growth and focusing on avoiding energy and really embracing tech, consumer staples, and some of the information technology. Same thing is true on the fixed income side, although slightly different. 50% of our portfolio is involved with government quality securities, high quality agency mortgage backs, and so forth. But on the corporate side, we really drift towards those higher rated companies with high ESG scores that really will stand the test of time because of the strength of their balance sheets in these very trying economic times. And so when you combine those, you have a very strong ESG oriented portfolio that, quite frankly, good times or bad, has done extremely well. And so we think going forward that there will be more interest in ESG, more funds will be flowing into ESG. Here's one little tidbit just to let you know what the strength of that is. Just in the last week, it's amazing. Last week we saw that ESGU, which is the iShares USA ESG optimized ETF, very large fund, in 1 week alone, off the back of all the adversity, they pulled in $2.1 billion dollars. That virtually doubled the fund from the March low of the S&P 500, all ESG. And so it's been one of the fastest growing funds on the equity side, and I suspect we're going to see a lot more of that in the months ahead.
All right, Bob, thank you so much for speaking with us today.
Thank you, Jill.
All right, and thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.